Welcome to the Deep Dive. Today, we are strapping in for a pretty high-stakes history lesson.
Yeah, and one that feels less like history and much more like a terrifying warning label.
Exactly. A warning label slapped right across the front page of today's financial news. We're diving into a really monumental new work of financial journalism that it refuses to let the past stay buried.
That's right. And we are not just looking backward today. We're examining a blueprint. I mean, a detailed schematic for how financial euphoria turns into, well, societal ruin.
The source material for this deep dive is Andrew Ross Sorkin's exhaustive new book, 1929, Inside the Greatest Crash in Wall Street History and How It Shattered a Nation.
And if that name Sorkin rings a bell, there's a very good reason.
Oh, yeah. He's the same financial journalist who spent years giving us Too Big to Fail.
Which is still, I think, the definitive fly-on-the-wall history of the 2008 banking crisis.
For sure. And now, 16 years later, he's applying that same kind of narrative intensity to the most pivotal market collapse of all time, 1929.
He really positions this book as the spiritual and, I would say, deeply urgent successor to his last one.
And our mission today is, I think, absolutely critical for anyone trying to navigate the current financial environment.
Totally. We need to extract Sorkin's core thesis. He argues that the dizzying highs, the hubris and the brutal lows of 1929, they don't just vaguely resemble the world of 2025.
No, it's much more than that. He says they eerily mirror it.
And the core argument is simple, but pretty devastating. The crash is ultimately a tale of power, psychology, and the seductive illusion that blinds us all.
That illusion, of course, being the most dangerous phrase in finance.
The one that basically guarantees a crash.
This time is different.
Right.
So our goal is to focus on the specific structural, psychological, and quantitative parallels Sorkin draws between 1929 and today.
Because if 1929 really is a blueprint, we need to know exactly which walls are cracking, which pipes are leaking leverage,
and which explosive charges are being rebuilt right now into the current financial structure.
This is an urgent deep dive. It's really designed to arm you with the context you need.
Sorkin believes we are standing at a point of maximum risk, fueled by the same converging forces that led to disaster a century ago. So, let's unpack the specifics.
Okay, let's get into it. When we talk about Sorkin's approach, this is not a dry academic study of GDP and tariffs.
Not at all. This is immersive history.
So what's the big difference between 1929 and other, excellent histories like J.K. Galbraith's classic work on the crash?
It's the method. Sorkin brings a modern journalistic sensibility to it. This is an academic macroeconomics focused just on policy errors.
Right.
It's a tick-tock, a minute-by-minute narrative applied to events that are 100 years old. His goal was to reconstruct the human drama of the people making decisions, often in, panic or hubris, in real time.
That's what makes it feel so immediate. And to get that fly-on-the-wall feeling for 1929, he spent 8 years on this.
8 years.
Relying on what he calls unparalleled access to newly uncovered personal letters, private diaries, unpublished papers. It really does take history and turn it into a human thriller.
Absolutely. The critical element Sorkin wanted to isolate was the human equation.
Exactly. He wanted to understand who these powerful people were, what they said to each other behind closed doors, and critically, their motivations and their incentives.
And that lens, that focus on the human element, allows him to dissect the real engine of any crisis, whether it's 1929 or 2008.
Which is always human folly, just amplified by greed and technology.
And when you talk about human folly, you have to start with the iconoclast, right? The ultimate outsider speculator who saw the whole fragile structure for what it was.
That's Jesse Livermore. Sorkin profiles him as this legendary speculator, often called the Big Short of 1929.
The guy who got it right.
He was the famed operator who correctly predicted the crash, shorted the market ruthlessly, and when everything imploded, he walked away with approximately $100 million.
Wow. Which in that era is just an absolutely staggering sum.
I mean, $100 million in 1929 is arguably equivalent to several billion today. He sounds like a protagonist in a modern movie.
He does, but Sorkin presents his methods as this dark study in paranoia and total control.
Indeed. Livermore was famously reclusive. He operated not from the exchange floor, but from his own private office.
Right.
Using a battery of dedicated private phone lines connected to a trusted network of his own people on the floor of the exchange, he basically had his own private market intelligence network.
And that was all designed to bypass the official information channels. So why the secrecy? Why the private network? What was he trying to avoid?
Well, that level of secrecy was absolutely necessary. It allowed him to operate outside the rampant, clubby market manipulation of the era.
Where insider trading was just normal.
It wasn't just common, it was expected. He was known for running these pool operations, where big groups of investors would coordinate to artificially inflate or deflate a stock price, only to dump it on unsuspecting retail investors.
He was a master of the game.
A master. And mastering it required total opacity.
And this is where that parallel to today becomes deeply unsettling.
Sorkin draws a direct line. Livermore's opaque, personalized, network-driven trading system. It has profound echoes today.
In what way?
Well, think of the modern crypto market. It's so often driven by anonymous whales using private, high-speed trading platforms.
With zero regulatory oversight.
Right. And they're manipulating prices based on internal chat groups or social media pumps. It's the same dynamic of opacity and personalized networks designed to exploit the public market, just, accelerated and globalized.
But Livermore's story, as Sorkin tells it, isn't a celebration of financial genius.
No, it's a tragedy that illustrates the ultimate price of euphoria and ruin.
He was the master of the market, the ultimate skeptic who saw the crash coming, yet he was ultimately destroyed by it.
Well, by the compulsion of the game itself, he ended up losing all his money, making it back again through these incredible efforts, and then losing it all one final time.
And his tragic story concluded with his suicide in 1940.
It just speaks volumes about the inability to escape the addiction.
The psychological insight here is truly chilling. Sorkin includes this one anecdote that just perfectly captures this compulsion.
Yes. A young banker once asked Livermore why, after he made his $100 million fortune in 1929, he didn't just, siphon off $2 or $3 million.
Enough to live comfortably forever.
Right. Just walk away.
Yeah.
And Livermore's reaction was described as contemptuous. He literally didn't understand the question. He reportedly asked, "Why would I want to be so poor?"
Wow.
Yeah.
If you hear that, you realize it was never about accumulating wealth for comfort or security.
Not at all. It was about the chase, the score, the sheer psychological adrenaline rush of high-stakes risk.
So the financial acumen, the ability to predict the crash, was entirely secondary to the psychological compulsion to always be in the game.
And that is the enduring, constant human factor Sorkin identifies, whether it's Livermore in the 1920s or a high-frequency trader or a meme coin speculator today.
The system is built on people who cannot stop dancing when the music is playing.
Even when they know, deep down, the music is about to stop.
That sets up the perfect contrast. Sorkin immediately pivots from the outsider speculator, Livermore, to the institutional hubris at the very heart of the establishment.
And that brings us to Charles Mitchell, or Sunshine Charlie.
Sunshine Charlie.
He was the high-profile president of National City Bank, which is the direct predecessor to modern-day Citicorp.
So he was the public face of the Roaring Twenties boom, exuding confidence, encouraging everyone to invest.
That was his public persona. But Sorkin's access lets us peek behind that mask.
So what did he look like in private?
He was terrified. Sorkin shares an excerpt detailing Mitchell's deepest private fear that public loss of confidence might spark a run on the country's largest bank.
He knew how fragile it was.
He realized the whole foundation of the system was psychological. If people lost faith in his 58 branches, the entire structure would just collapse instantly. The man selling confidence was privately consumed by a fear of fragility.
But Mitchell's real fall from grace, the event that truly eviscerated public trust, came after the crash.
Yes, during the explosive Pecora Senate investigation.
What happened there?
The revelations unearthed by Ferdinand Pecora were catastrophic for Wall Street's reputation. Pecora was this relentless prosecutor who dragged the titans of finance before the Senate.
And he exposed their deep corruption and their tax avoidance schemes.
And the most damning revelation about Sunshine Charlie was that he had completely eliminated his income tax obligation in 1929.
How did he do that?
By performing a massive artificial transaction, selling a huge block of his National City Bank holdings to his wife at a loss.
So he created this massive paper tax loss,
which wiped out his entire taxable income.
So he was simultaneously encouraging the public to invest in the system while legally maneuvering to avoid contributing to the nation he was supposedly leading to prosperity.
The audacity was staggering. And the exposure during Pecora's high-profile hearings led to just this white-hot public fury.
And this is where Sorkin connects the dots across the centuries, drawing that direct institutional parallel.
Yes, and that connection is so central to his argument about the inherent flaw in the system's DNA.
It's not just about one bad actor.
Not at all. Sorkin explicitly links Mitchell's risk-taking and institutional disregard for accountability to that famous, haunting 2007 quote from Citigroup CEO Chuck Prince.
Oh, yeah. When the music's playing, you have to dance.
Exactly. The profound realization is that the exact same institution, National City Bank evolving into Citigroup, was at the epicenter of both the 1929 collapse and the 2008 collapse.
Wow.
Driven by the exact same institutional hubris and an addiction to high-stakes, opaque risk-taking.
That suggests the problem isn't a few rogue individuals who pop up every now and then.
No, it's a systemic, cyclical, and cultural flaw rooted in the DNA of specific financial institutions, a total failure to internalize the lessons of the previous crisis.
And it wasn't just Mitchell, right? Sorkin shows this was systemic.
Oh, completely. Sorkin's research shows the corruption was systemic among the financial elite. He found that none of the top 20 partners of J.P. Morgan Bank paid taxes in 1931 and 1932.
None of them.
And these partners were the financial kingmakers, sitting on dozens of corporate boards simultaneously.
Which created this vast, opaque web of interlocking directorates and conflicts of interest.
Right. So when the crash happened and people started demanding answers, the Pecora investigations didn't just expose bad trading calls.
No, they exposed wholesale financial sabotage and corruption by the supposed custodians of the nation's wealth.
Exactly. The subtitle of the book, How It Shattered a Nation, refers primarily to that collapse of trust.
When these tax evasion scandals and conflicts of interest were broadcast to the nation, it fueled a massive, and I'd say justifiable, public fury.
The public realized the game had been rigged by the powerful elite. And that fury wasn't just emotional.
It had material economic consequences.
It amplified the disaster. Sorkin really emphasizes that the market crash wasn't instant, like you see in a movie. It was a slow-motion catastrophe spread over 4 agonizing years.
Right. The numbers are brutal. The market was down 17% in 1929.
Then another 33% in 1930.
And then a gut-wrenching 50% more in 1931.
That is an excruciating, agonizing plunge. It's a sustained economic depression, masquerading as a market correction.
And the collapse of trust is what turned a market correction into the Great Depression.
The falling dominoes affect market decline, leading to credit contraction, drops in consumption, mass unemployment. It was all accelerated by the public's realization that the elite had been looting the system while profiting from their pain.
And that collective anger led directly to the political will necessary to create the 20th century guardrails.
Glass-Steagall, deposit insurance, the SEC, all born from that fury.
So those historical lessons, the human psychology, the institutional hubris, the collapse of trust, they lead us perfectly to Sorkin's main point, comparing the structural similarities across the crises.
And this is where the historical blueprint transitions into an urgent warning for 2025.
Okay, let's shift gears and really examine the comparative framework Sorkin uses to analyze these crises, 1929, 2000, 2008, and today.
He asserts that the same 3 destructive forces are, and I quote, once again converging.
Those forces are speculation, leverage, and political paralysis.
Let's start with speculation, which Sorkin identifies as always being driven by the seductive narrative of a new thing.
This is the core mechanism of the "this time is different" illusion, isn't it?
It is. Every single financial bubble has to be justified by some transformative technology or asset class that supposedly renders traditional valuation metrics obsolete.
We're told the old rules just don't apply anymore.
Right.
So in 1929, what was the new thing that held that transformative promise?
The undisputed king of transformative technology was the Radio Corporation of America, or RCA. Sorkin calls it the NVIDIA of 1929.
What a perfect comparison.
It was the stock everyone had to own because it represented the future of communication, entertainment, and ultimately permanent prosperity.
So RCA stock didn't trade on its current limited revenue.
No, it traded based on the infinite potential of every home one day having a radio and the subsequent advertising revenue and cultural power that implied.
And that speculative narrative is precisely what drove the dot-com bubble in 2000.
Exactly. The internet was the new thing, leading to the use of absurd bespoke metrics like clicks and eyeballs to justify zero-earning companies. The technology itself was revolutionary, but the narrative,
that it created a permanent new plateau of asset valuation.
that was pure bubble territory.
Which brings us to 2025. And Sorkin is unequivocal about the current speculative driver.
The driver, Sorkin insists, is artificial intelligence. And he makes a truly startling, almost frightening claim about the centralization of our current economic health.
What's the claim?
He says if we took out spending on AI, our economy would be flat.
Wow. That is a profound statement about fragility.
It is. It means that much of the perceived remarkable boom we're experiencing is centralized around one concentrated speculative narrative.
It absolutely mirrors the 1920s belief that radio, the automobile, and consumer credit had created an irreversible permanent prosperity that justified endless upward trajectories for companies like RCA.
And the danger isn't AI's potential, which is real. The danger is the hyper-excessive valuation and speculation it has fostered.
Where companies are valued at trillions based on revenue that may or may not materialize 10 years from now.
Exactly. When one concentrated speculative driver is propping up the entire economy, the system's vulnerability to a shock is just maximized.
Okay, so speculation provides the narrative and the high prices, but the second force, leverage, is what he calls the match that lights the fire.
It's what turns a correction into a catastrophe. Sorkin defines it simply. Debt is the match that lights the fire of every financial crisis.
It's the mechanism that transforms localized losses into a systemic collapse.
Because when debt is tied to inflated assets, the loss is magnified 10 or 20 times over, causing cascading failures.
In 1929, as we talked about, leverage was deliberately democratized.
Yes, that era normalized consumer debt for the first time, pioneered by giants like GMAs and Sears. And in the financial markets, almost anyone could buy on margin with as little as 10% down.
So you only needed $100 to control $1,000 worth of stock.
Right. Which means when the market went down 11% on Black Monday, everyone who bought on 10% margin was wiped out instantly.
By 2008, the mechanism had become far more opaque.
Correct. That leverage was hidden away in the unregulated shadow banking system. The CDOs, the mortgage-backed securities, the special purpose vehicles.
It was complex, intentionally opaque, and interconnected.
But the underlying mechanism was the same, financing high-risk, illiquid assets with massive short-term debt.
Now we come to 2025, and this is where Sorkin sees the structural risk shifting dramatically, even after Dodd-Frank and other post-2008 reforms.
He argues that the regulations didn't eliminate leverage, they just forced it to migrate.
They forced it out of the highly regulated commercial banks and into
a new, incredibly deep shadow. Sorkin points specifically to the explosion of private credit funds and corporate borrowing that occur entirely outside traditional bank supervision.
We need to go deeper here. Why is this new market the shadow banking system of 2025?
Because it is immense. We're talking multi-trillion dollars, and largely unregulated by the Federal Reserve or the SEC in the same way as traditional commercial lending.
So what are these funds doing?
Private credit funds lend money directly to companies, often for leveraged buyouts, that can't get traditional bank loans or can't easily access public bond markets. So the risk profile is inherently higher.
What are the specific dangers in private credit that Sorkin is worried about?
Well, there are three major issues. First, opacity and illiquidity. Unlike a publicly traded bond, private credit loans are extremely difficult to value quickly. There's no daily market price.
So if the economy falters, suddenly nobody knows what the real value of these assets is.
Exactly. Second is covenant light. These loans often have fewer covenants, the legal protections that traditional banks demand to ensure timely payment or secure collateral.
Meaning the lenders, the private funds, have fewer rights when the borrower runs into trouble.
Yes. And third, and this is key, is interconnectedness. Because these funds often feed into institutional investors, like pension funds and insurers, the quiet machinery of our retirement savings.
A failure here could ripple out into the broader economy.
Just like the failure of those opaque structured products did in 2008. The guardrails were sidestepped, and leverage simply migrated to a darker, more complex, and less observable corner of the financial system.
The mechanism of leverage is crucial, but as we learned from Livermore, the human element is the accelerant.
Which brings us to the third crucial force, the mania of the crowd.
It's the constant psychological factor that drives prices to truly absurd levels.
In 1929, Sorkin recounts the height of the public frenzy. CEOs were celebrities, market tips were exchanged like common gossip.
And retail investors were so desperate for an edge, they were literally following the stock-picking advice of astrologers.
Like Evangeline Adams.
Yeah.
Today, the astrologer has been replaced by the meme coin influencer.
It's the same dynamic.
Exactly.
Yeah.
In 2000, it was the day trader who thought the instantaneous access of the internet made them a professional investor. In 2025, Sorkin points directly to the instantaneous, zero-friction, global speculation driven by meme coins and crypto.
And his own personal experience provides the perfect, terrifying anecdote.
The Sorkin coin.
Right.
It's Exhibit A for the velocity of modern mania. He recounts joking with BlackRock CEO Larry Fink about creating a speculative coin named after himself.
And within 2 hours of that conversation being reported,
A Sorkin coin was created by speculators leveraging decentralized finance platforms.
That's a stunning realization of frictionless finance, but is this truly a sign of systemic fragility, or is it just, anecdotal noise on the fringes of the market?
That's a brilliant question, and Sorkin's answer is that the velocity is the risk.
How so?
That joke coin peaked at $170 million in daily trading volume before collapsing to virtually nothing. It demonstrated that instantaneous, zero-friction, global capital movement can be directed at assets with zero underlying value.
And that kind of liquidity chasing pure speculation drives prices up everywhere.
Pushing capital into riskier, more opaque areas like private credit because safe assets look comparatively boring.
And the pitch used to sell this madness is the final cyclical irony.
It's the same siren song used to sell toxic, highly leveraged margin loans in 1929. Democratizing finance.
It sounds populist and empowering.
But Sorkin warns it is often just a slogan used by Wall Street to justify the democratization of toxic, highly leveraged, and speculative risk, ultimately exposing the average person to ruin.
The human folly is the constant.
The tools are just exponentially faster, more global, and less regulated now.
Okay, so to ground these narrative and psychological parallels, Sorkin introduces cold, hard, quantitative data.
Right, moving us beyond the anecdotes of Livermore and Mitchell.
He focuses specifically on market valuations using the price-to-earnings, or PE, ratio, and this is where the blueprint truly becomes chilling.
It confirms that the structural fears are quantitative, not just, anecdotal. The PE ratio is the core objective measure of market froth.
It tells us how much investors are willing to pay for $1 of corporate earnings.
And historically, the average PE ratio is around 15. When it doubles, you know you are in speculative territory. Sorkin's data table presents a stunning conclusion about the 2025 market relative to past peaks.
Let's lay out the key metrics. The peak of the 2000 dot-com bubble was driven by a PE ratio of 44.
The peak of the 1929 Roaring Twenties had a PE ratio of 33.
And the current AI boom in 2025.
A PE of 39.
So based on this central objective valuation metric, the 2025 market is significantly more expensive and frothy, more reliant on speculative future growth than the 1929 market was at its absolute peak.
That's staggering.
I mean, we are in more expensive, more speculative territory now than we were when Groucho Marx and Winston Churchill were losing their fortunes.
The quantitative data confirms Sorkin's thesis that the structural parallels are real.
Wow. So with the numbers being this high, how can you, the listener, even keep an objective eye on this kind of macro-level risk? It's so easy to get lost in the day-to-day headlines.
That's a great question. And it's essential to track tools that look at total market capitalization versus the size of the economy.
How do you do that?
Well, one excellent way to track the total market temperature is through metrics like the Buffett Indicator, which compares the total market cap of publicly traded companies to the nation's GDP.
And when that indicator spikes?
It signals a high risk of overvaluation. For those interested in tracking this daily, I would encourage you to check out the Buffett Indicator iOS app in the Apple App Store.
Okay.
It's a great tool for receiving daily, up-to-date reminders about overall market health and potential bubbles. It offers that necessary quantitative perspective that Sorkin's analysis demands.
That focus on quantitative valuation leads us directly to Sorkin's next major point, which is the political and regulatory environment.
The systematic dismantling of the guardrails put in place because of 1929 and 2008.
And this is where his warning becomes particularly blunt.
Yeah, he states that the essential protections built because of the lessons learned are coming down or being moved against. He cites the Consumer Protection Bureau, the CFPB, established after 2008.
Which now practically doesn't exist anymore in its original aggressive consumer advocacy function.
But the deepest irony, and the trend that most directly echoes the democratizing risk pitch of 1929, is the political and lobbying push to put high-risk, illiquid assets into public retirement accounts.
That is the ultimate betrayal of institutional memory.
We are talking specifically about the efforts to greenlight placing high-risk private equity and venture capital investments inside public 401k retirement funds.
This is a direct, calculated assault on the core philosophy that arose from the Great Depression.
It is. The regulations of the 1930s were designed to ensure that public money, especially retirement money, was protected from opaque, illiquid, and conflict-ridden assets.
And private equity and venture capital are the definition of opaque.
Exactly. They don't trade publicly. Their valuations are often estimations, not market prices, and they carry massive illiquidity risk. If a huge number of Americans suddenly need to withdraw from their 401ks during a crisis,
Those funds holding PEVC might not be able to sell those assets quickly or at all.
forcing them to sell their liquid assets at fire sale prices, which makes the whole crisis worse.
And the political pitch used to sell this risky exposure is what?
It's the exact same slogan, democratizing access to high returns, that was used to sell highly leveraged margin loans in 1929.
Wow.
The purpose of the original regulation was to impose a fiduciary duty to protect public savings. Now, that duty is being undermined by a profit-driven push to open up trillions of retirement dollars to fees and risk generated by the least transparent assets in the market,
It's a cyclical betrayal of trust.
proving that the incentives for short-term profit outweigh the long-term institutional memory of a crisis.
These forces create the conditions for a crash, but Sorkin warns about the third converging force, political paralysis.
This is the key factor that turns a market shock into a societal catastrophe. He provides a crucial history lesson here about the difference between a crash and a depression.
What's the lesson?
Sorkin explicitly states that protectionist policies were the first domino in 1929's collapse. He's referring primarily to the 1930 passage of the Smoot-Hawley Tariff Act.
Most people remember the stock market crash, but they forget the policy catastrophe that followed. So how did a tariff act turn a deep recession into the Great Depression?
It was catastrophic because it instantly choked off international trade and capital flows. Smoot-Hawley dramatically raised tariffs on thousands of imported goods.
He was meant to protect American industry.
But instead, it triggered immediate, massive retaliatory tariffs from 20 other trading partners, Canada, France, the UK, who just slammed the door shut on American exports.
So American farmers and manufacturers who relied on overseas sales suddenly had no markets.
Precisely. Global trade plummeted by about 2/3. This choked off the demand for American goods, deepening the industrial and agricultural crisis far beyond what the stock market crash alone would have caused.
So the crash was a domestic market event. The depression was a global policy catastrophe.
Exacerbated by political isolationism. And Sorkin warns that today's global environment, defined by tariffs and trade wars and increasing nationalism, is an echo of that dangerous political isolationism.
The underlying logic is identical.
And Sorkin warns that today's political paralysis, the deep partisan divide, and lack of institutional consensus is primed to repeat that mistake. A future policy response to a major shock could amplify the disaster rather than mitigate it, just as in 1930.
Turning a cyclical downturn into a multi-year economic catastrophe.
Right.
All these parallels, the frothy valuation, the hidden leverage, the retail mania, the eroding guardrails, they all suggest a reckoning is inevitable.
But Sorkin adds one final devastating piece to his blueprint that explains why the next crash might be fundamentally different and worse than any we've experienced in living memory.
This brings us to the ultimate, most sobering takeaway from Sorkin's deep dive, the one that truly separates today's risk profile from all previous crises. He isn't hedging his bets.
No, he states it unequivocally. I'm positive there's a crash coming, I just can't tell you when, and I can't tell you how deep.
And what changes the entire risk landscape? What makes the 2025 situation structurally worse than 1929 or 2008?
Is what Sorkin terms the debt trap. This is the critical fiscal difference that fundamentally changes the government's ability to respond.
We have to contrast the government's fiscal status across these two periods. So when the 1929 crash hit, what was the state of the American balance sheet?
In 1929, America was fiscally pristine. The country actually had a budget surplus and hardly any debt.
That's the crucial, often forgotten context.
When the economy collapsed, the government had the immediate, unquestioned fiscal capacity to become the buyer of last resort and execute massive New Deal spending later in the decade.
Okay, now compare that to 2025.
Today, America... That single difference, Sorkin argues, renders the crisis playbook of the last two generations largely obsolete.
The standard playbook, which Sorkin himself chronicled in Too Big to Fail in 2008, was straightforward, if controversial.
Right. When the system seizes up, the government must throw staggering amounts of money and liquidity at the problem. You execute massive bailouts, TARP, Fed liquidity injections, quantitative easing, huge fiscal stimulus.
The goal was to stop the cascade immediately by guaranteeing the system wouldn't run out of cash.
Correct. But Sorkin asks the haunting rhetorical question. With today's enormous debt, can we execute that playbook again without causing a secondary sovereign crisis?
Explain the mechanism of paralysis. Why can't the government just borrow another few $1 trillion to stop the bleeding?
Because the buyer of last resort, the U.S. government, is fiscally constrained in a way it wasn't in 1929 or even 2008. If the government needs to issue massive new debt or bonds to fund a bailout.
And the market is already demanding a high-risk premium due to the sheer volume of existing debt.
The cost of borrowing becomes exorbitant. Bondholders, the market, may demand an extraordinary amount of money for the risk, meaning sky-high interest rates.
That dramatically increases the cost of the bailout and simultaneously starves other parts of the economy.
Precisely. This phenomenon, known as fiscal crowding out, means that every dollar borrowed for the bailout comes at a painful opportunity cost. These high interest rates could effectively crowd out private investment, restrict necessary infrastructure or social spending, and delay any genuine recovery.
So the very solution used to fight the crisis
Massive borrowing.
could become the problem itself, paralyzing the government's ability to act decisively.
And efficiently.
This fiscal constraint, combined with the lack of regulatory guardrails, changes the entire implication of Sorkin's warning.
It does. This is the profound final implication. The next crash may be the first one in modern history that the government is either powerless or fiscally paralyzed to stop or swiftly reverse.
So it won't be a V-shaped 2008-style recovery where government intervention limits the damage to a couple of years.
Instead of a quick shock and recovery, we are looking at the possibility of that full, multi-year falling dominoes collapse, 1929 to 1933 style.
Which truly does shatter a nation socially and economically.
The debt trap is the critical difference that turns a typical financial cycle into a potential societal disaster. Sorkin's work serves as the most urgent possible warning that the structure of the system has become more fragile, not less.
And the tools we successfully used to flood the last crises, massive, quick government borrowing, may be unavailable to fix the next one.
This deep dive into Sorkin's 1929 truly delivers on the promise of a blueprint. We've dissected the three central converging parallels: AI-fueled speculation reminiscent of RCA,
Leverage hidden in the opaque, multi-trillion-dollar private credit market.
and the instantaneous global mania of the meme coin crowd. And we've recognized the one overwhelming, critical difference: the debt trap.
This fiscal constraint threatens to undermine any governmental response, forcing us to face a crash that could be deeper and longer than any in living memory.
Sorkin's enduring lesson is that the human psychology driving euphoria and ruin never changes.
Only the technology and the mechanism of leverage evolve.
That brings us back to the fundamental question that followed the 1929 crash, which Sorkin notes was, who can be trusted?
The public lost faith in the institutions they thought were managing the system responsibly. The bankers, the politicians, the regulators.
And given the modern financial industry's success in dismantling crucial protections under the seductive banner of democratizing finance, we have to ask ourselves a very provocative question as we look toward the future.
In a financial system now defined by hidden leverage, instantaneous global speculation on assets with no underlying value, and enormous public debt that constrains our ability to bail ourselves out.
Is the greatest modern risk not the crash itself, but our collective and institutional unwillingness to ask that central question: who can be trusted to run this system until it's too late?
A sobering thought. Use this blueprint. Observe the current financial landscape with a critical eye.
Track the structural metrics, and remember that what looks like innovation can often just be leverage wearing a new, faster disguise.
And on that note, we close this deep dive. We hope this knowledge helps you navigate the current cycle with a little more skepticism and a lot more context. We'll see you next time.